We are now live. Hi, everyone. We're here today for our Feliciano live session. Our topic today is the stock market, what's happening. We are here with Jim Merli. He's the former head of FID Syndicate at Nomura Securities. He is also an alum of the Feliciano School of Business, as well as an adjunct professor and donor to the university. So we welcome Jim. And as we're going through our questions here, feel free to ask your questions, and we'll get to as many as we can. So I'll start off with the first question. So can you briefly explain what is currently happening with the stock market?
Sure. So we're experienced a period of extreme volatility here in the last week and a half to 2 weeks. And I think what's gotten people to take notice is that we had such a long period, almost 2 years, of little to no volatility. So by that, I mean we didn't have big swings on an intraday basis. The market just continued to sort of march higher over the last several years. And there was quite a bit of investors and products that were created to take advantage of that low volatility environment. What's happened in the last 2 weeks, and some people are pointing to rates, some people are pointing to the strength in the economy, some people are pointing to inflation fears as all things that might have precipitated this increased volatility. But in my opinion, the bottom line is that we were up almost 20% last year, 2017. For the month of January, we were up another 5 to 6% in the S&P 500 without any sort of pullback over that time period, which is highly unusual from a historical perspective. And so whatever the catalyst was, whether you want to point to rates or inflation fears or the Federal Reserve, whatever the catalyst is that you want to point to, we were overdue for a correction, and we got that correction last week. I think it just came a lot quicker and a lot more aggressively than maybe people had expected.
So for those of you who just joined us, we're here for our Feliciano Live, talking about the stock market and what's happening. We have the pleasure of having Jim Merli with us. He's the former head of FID Syndicate at Nomura Securities. He's also an adjunct professor here at the school, as well as an alum of the school and a donor at the university. So second question, Jim, is how bad is it really?
Yeah, I think that's something that really needs to be, put into perspective. As I just said a moment ago, the significant rally that we've experienced not only in the last 12 months, but really since the end of the crisis in 2009. I mean, the stock market got down in the low 6,000s on the Dow. Before this latest bout of volatility, we were at 26,000. So to put into perspective, how bad is it really? We went almost 2 years without a 10% correction in the stock market, which is highly unusual. We got that last week. So, S&Ps were down just over 10%, which technically qualifies as a stock market correction. And now here we are this week, we've retraced over 50% of that loss. So we've already gained back over 5% of that 10% loss. So how bad is it really? I don't think it's that bad. I think it needs to be put into perspective. It certainly felt bad, when we were down 1,700 points in one day. But if you take a step back and look at, where we are today versus where we were a year ago this time, or certainly 2 years ago this time, we've had a nice move. The economy's, hitting on all cylinders. Unemployment's low, inflation's low, corporate earnings are strong. So it's really not that bad.
So we actually have a live question. How are retirement accounts being affected by this?
Well, retirement accounts, like any other account, on a mark-to-market basis, is going to see some increased price volatility for the last month, depending on what you own in that retirement account. If you own stocks, you're going to see a lower month-end value at the end of this month than you saw at the end of last month. That being said, retirement accounts are meant to be for retirement, so it's a long-term investment, and it's not something that you should really be overly concerned about on a week-to-week, day-to-day, or month-to-month basis.
So for those of you who just joined us, we're here talking about the stock market, specifically what's going on in the market over the past few weeks. We're here with Jim Merli. He's the former head of FID Syndicate at Nomura Securities. Jim is also an adjunct professor here at the Feliciano School of Business, as well as an alum and donor at the university. And my next question is, how does this affect the housing market?
Sure. So the housing market, mortgage rates in particular, are historically typically tied to the rate on the 10-year Treasury. That's sort of a benchmark that mortgage companies, banks, mortgage brokers use to set mortgage rates. And those rates have moved higher over the course of the last few months. But again, similar to what we just said about the stock market, to put that into perspective, we were at all-time historically low rates on 10-year Treasuries. So therefore, we were at all-time historically low mortgage rates. If you look at the last 10 years, the 10-year Treasury has traded between kind of 2 and 4%. And right now, today, we're just inside of 3%. So we're kind of in the middle of that range. If you went back further, pre-crisis, 10-year Treasury would have traded much more in a range of something like 5 to 7%. So we're still at historically low levels. It is pushing up mortgage rates, and it will continue to push up mortgage rates. But if you look at where mortgage rates are from a historical perspective, I think we still have a long ways to go before that really starts to have a serious impact on the housing market.
So we have a live question. When does a stock market drop become something that poses a broader risk to the financial system?
I think, number one, the degree of it. So a 10% correction is just that, a 10% correction. It's not something that, is typically, historically, has broad-based implications for the economy. When a stock market correction becomes more pronounced, deeper, so more like 20 or 25%, and longer, so that it's not bouncing back in a week, but that it stays down for a prolonged period of time, it starts to impact, something that economists call the wealth effect, which is how people feel about, their position and their disposable income. And it starts to impact people's decisions to buy products or to go on vacations or, to invest in the markets. And so that is when it has an impact. There's no particular hard and fast rule of, a specific number, but it's more about the duration of the downturn and the severity of the downturn.
Okay, we have a live question. Yesterday, the Goldman Sachs CEO stated that due to the Trump administration's spending spree, it will overheat the economy, to have a negative effect on the economy. Do you agree or disagree?
I heard some of that interview with the CEO of Goldman. He was talking about the infrastructure and the tax cut all being stimulative to the economy, and heating up things in terms of pushing up on labor costs and stretching incomes and so forth. Again, I think we have a ways to go for that. I don't think that is necessarily going to have a negative impact on the economy immediately. If you look at what people are doing, what companies have been announcing here for the fourth quarter, and what their forecasts are for 2018, they all continue to be very positive from the standpoint of what the impact the tax cuts have on their particular business.
For those new to the stock market, can you explain the difference between the bear and bull market, and which are we experiencing?
Yeah, I mean, those are just, names of, to sort of characterize. A bear market is obviously a negative one that continues to trade down for a, prolonged period of time. And a bull market is the inverse, so a positive performing stock market over an extended period of time. We've certainly have been in a bull market environment for really since 2009, which was the bottom post-crisis. So we were in a bear market in the midst of the financial crisis in 08, 09. We started to come out of that in late 09, early 2010, and we've technically been in a bull market since then.
So next question is, how long do you believe the current situation will last or expect it to last?
So if by the current situation you mean, or the question means, increased volatility, I would say that we are going to have increased volatility this year, 2018, relative to last year. And again, that's not to say that this is unusual. Having no volatility was unusual. So this isn't the anomaly. The last year and a half, 2 years was the anomaly when you had the VIX, which is a measure of volatility in the stock market, trading at very, very low levels. That was the anomaly. So I don't expect, and I don't think anyone is forecasting, that we're going to have the sort of extreme price swings that we saw last week on a regular basis. But I do expect that we will have more volatility in the coming year than we had over the course of the last year and a half to 2 years.
So for those of you who just joined us, we're here talking about the stock market with Jim Merli, who's the former head of FID Syndicate at Nomura Securities. Jim also is a professor here and also as a donor and an alum as well. So we have a couple more minutes with Jim. So if you have any questions, feel free to ask them live and I'll take them. So my final question is, and you may kind of answer this, but in your opinion, did the tax reform plan have a negative and positive effect to the stock market?
So right after the announcement, the market traded up. So back in December, and then if you looked at the price action in the stock market throughout the month of January, it was up another 5-6%. Overall, the knee-jerk reaction to the tax plan was positive from the standpoint of the repatriation of corporate earnings that will come back into the U.S., create jobs, to fund infrastructure projects, to increase tax revenues from the corporate perspective. So it had an initial positive response. Ultimately, how it plays out over time in terms of increasing the deficit and the funding that will be required, to offset that will remain to be seen. But the initial reaction from the stock market to the tax plan was a positive one.
And the final question, do you believe can the Dow hit 30,000 over the next 3 years?
Yes.
All right, great. Well, thank you thank you everyone for joining us, and we'll see you next Thursday. Thank you, Jim, for your time, and we'll see you next Thursday at the next Feliciano Live. Thank you.